Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. And today we are going to discuss hybrid funds. They saw big inflows of around 16,863 crore rupees. This is in October. It's been consistently moving up. And that's a significant rise of around 244% that we saw in September, where the inflows were around 4,901 crore rupees. So we'll understand the key drivers for this surge, the risks associated with this, and when does this category become ripe for investment. This and much more with Nitin Rao, CEO at InCred Wealth, and Prableen Bajpai, founder at FinFix Research and Analytics. Mr. Rao, Prableen, thank you so much for joining in today. But lady, let me start with you, because we saw that big surge and big inflows in the month of October, around 16,863 crore rupees. But is this a sustainable trend? What is driving the interest in this category?
Good afternoon, Sonal. Great to be on the show. I think it's the current scenario states that it's the volatility in the markets and, of course, the changes in the taxation. I think two primary factors which have driven the funds into the hybrid category. And that is not just in the month of October, Sonal. I think that's what the trend has been over the past few months. And if we just broadly analyze, extrapolate and just look at the past 13 months overall, starting from October 2023, we'll see that the monthly inflows are primarily the primary segment which drives, because within hybrids we have these 6 categories, and out of these 13 months it is actually the arbitrage funds which have led the contribution and the inflows into the broader category of hybrid funds in 10 out of the 13 months. And in 2 out of these 13 months it was the multi-asset category, and in 1, it was the dynamic asset allocation. So definitely it's the market volatility, deployment of funds, the decision-making becomes slightly more difficult for investors. Debt as a segment is less lucrative with the changes in taxation. So overall, I think arbitrage is definitely the space where the funds are getting parked. And then, of course, the hybrids, because of the market volatility and with their ability to protect the downside, I think overall it's sort of increased the interest. But interestingly, in the month of September, because we did actually see outflows from arbitrage, because it's used for parking purposes, Sonal. So I don't think the trend is sustainable, to answer your question. And I think it'll always be this huge inflows during specific funds and then the outflows during probably advanced tax payments and quarter-ending months. So I think it's not a sustainable trend, but overall good interest in the hybrid space for sure.
Okay, all right, take that point. So that's an important opinion coming in. Mr. Rao, do you agree with Prableen? Because if there's a difference in opinion, that is something that makes markets, right? But what do you make of the hybrid fund flows that we saw? Do you think it's a sustainable trend?
Thank you, Sonal, firstly, for having us around. I personally think hybrid funds is a trend which is here to stay. There are 2 main reasons for that. We've had long bull markets over the last 2 years across the world, and India is no different. And we are entering into a phase of reduced returns in equity over the next year with a lot of volatility. In such scenarios, where do clients protect their money is one concern. The second concern, like was mentioned, was debt taxation, which has now become marginal tax rate in almost all categories. How can we kind of improve the returns and try and protect capital as an option for debt investors, which is where hybrid funds come in? So like was rightly mentioned, arbitrage is one area which I think gets about 45% of the money. But an interesting trend within all that is also multiple asset allocation funds, balanced dynamic funds, and equity savings funds are also seeing maybe 30 to 40% of the flows, which is a result of the changes in the taxation and the fact that volatility and tax planning makes this segment attractive. More importantly, even the equity savings scheme is now coming up as an attractive option to FD investors in hybrids, while balanced advantage and multi-asset allocation are coming as attractive options for volatility investors. Hence, I think this trend will kind of improve going on from here.
Okay, so it will improve. So just to follow up on that, I know it's it can't get too specific. So everyone has been thinking that maybe 2025 year could be the year for hybrid multi-cap funds. If that is happening, what are some of the other factors, according to you, Mr. Rao, which could work here?
See, firstly, we saw a strong bull market where I think 25-30% returns was quite standard across most categories. Now we are seeing a lot of volatility in India with stretched valuations and a slowing economy. We are seeing a topping of markets across the world on valuations, and hence internally we believe that here on returns from equities will be subdued. We also think debt returns may see some upsides as the interest rates come down, but it will be volatile. China remains volatile. All these factors reduces confidence of investing directly into equity type of mutual funds. How do you balance that? By balancing debt and equity in products and fund managers who try and balance views out into good strategies. And that's why I think they are perfect. If the equity markets will give 10-12% returns, if debt gives 7-8% returns, hybrid category, if thought of properly, can give you 10 plus kind of returns quite easily.
Okay, all right. So that's the outlook, what could happen possibly in 2025. So Prableen, is it fair to say during market corrections, it's better to look at hybrid funds? That's what we saw in October, right? A sharp correction. And how do they handle the dips and give better returns in this case?
Absolutely, Sonal. I think, like Mr. Rao has mentioned, investors definitely are looking at the risk management nowadays because they understand that with volatile markets, you're looking at more stable returns, and that is where hybrids come in. And I think most of them have actually done a great job with containing the downside. So when market corrections are concerned, it is not that you just move into a hybrid fund, but probably the newer allocations, that is what is going into the hybrid funds, and especially for those funds, Sonal, which are with a 3 to 5 year point of view. Let's say you have your child's education in the next 4 years, then probably at these levels, you don't want to take up your equity exposure. You don't want to sit with all your money in the fixed deposit as well. So that is where hybrids come in. And broadly, if we just look at the category, how they have been able to contain. So, the recent fall, which we saw in Nifty 50, where from the 26th of September till about 21st of November, Nifty was down close to 11%, 10.93%. Category averages across the hybrid segment, I think they performed wonderfully. If we look at the balanced advantage, the category average was down by about 4%, much lesser than the broader markets. Multi-asset again was down by 5%, half of Nifty 50's fall. Arbitrage, of course, was in the positive because that's what it's meant for. Equity savings, the schemes where again, very small, you get equity taxation, but the unhedged allocation to equity is usually very little. It was down by about 2%. And of course, the category like the dynamic asset allocation, aggressive hybrid, they were also, much lesser. The fall was much lesser. So overall, I think they are doing a good job by protecting the downside. But at the same time, Sonal, the construct and, how these funds, within hybrids, it's these 6 different subcategories. And then within them, there are this different constructs, especially within the multi-asset and the balanced advantage space. So then the returns actually vary so much within the category as well. So investors, should not just invest looking at the category average. They have to deep down, and then look at what is best suited for their objective.
Oh, yes, that point is absolutely taken. So, Mr. Rao, coming to you, if we compare different categories, not the subcategories itself within hybrid funds, how have returns been during biggest monthly downsides and upsides? This gives a greater idea to investors, right? What a category does in a certain cycle.
So we did an analysis where we tried to see how different categories performed when the markets fell. And broadly, there have been some 7-8 instances where markets, as represented by Nifty, fell about 6-7%. And we have seen that the balanced advantage category and the aggressive hybrids would have only fallen about 3% broadly in those times, while the equity savings fell maybe 2%. Obviously, arbitrage went positive, and this is not once, but maybe 7-8 times in the last 4 or 5 years. So clearly on a market fall, because They do allocate some amount of money into categories which cover either other asset categories or hedging, etc. These funds have always outperform in a fall, and track record has shown that the alpha on the fall to the index has always been in excess of 3-4%. The other point that I want to also add is equity savings and arbitrage can also replicate FD type of returns on a recovery. So not only do they outperform on the fall, but they also give stability in a recovery on the market.
Okay, so historically, balance advantage funds have corrected lesser than what we've seen with some other categories. That point is well taken, and it's a very insightful discussion, but we have to get into a quick commercial break. On the other side, we'll continue our discussion with Prableen Bajpai and Nitin Rao, understanding everything about hybrid funds. Stay tuned for that. Welcome back. You're still tuned into MF Corner. We have with us Mr. Nitin Rao, CEO at InCred Wealth, and Ms. Prableen Bajpai, the founder at FinFix Research and Analytics. We've discussed so far how the subcategories in hybrid funds have done, why there's a lot of surge that we're seeing in terms of inflows. But Mr. Rao, how do we differ this category from flexi-cap funds, and why do they perform better in extreme market moves versus the other category?
An interesting question, but there are two different asset categories. Flexi cap essentially looks at a distribution across equities, and they play between large cap, mid cap, and small cap as the fund management strategies. While hybrid funds will have equities in a similar distribution, maybe, but they also have maybe 20-30% in either other asset categories or in hedged products, which decreases the returns. The net result is that when the markets do very well, and that also we've seen over different time frames, say 6-7 times when the markets did very well, flexi cap funds have outperformed hybrids by a large margin. And I would logically say that the alpha over a balanced advantage or an aggressive hybrid will be 5-6%, which means they will give 5-6% more returns than the hybrid on the upside. But that's the very nature of the funds. But it's important to understand portfolios seem similar. It's only that a small percentage of the portfolio is locked into products which try to reduce volatility, which is why flexi cap will outperform on an up move, whereas on a down move, the hybrid will outperform the flexi cap.
Okay, that explains the analysis of the returns in these two categories as well. So, Prableen, while we're talking about how these asset categories perform in different market cycles, and especially for hybrids, you think that this outperformance might not sustain. So there could be some risk associated with hybrid funds as well, right? What are they? Who should not go for such funds?
Absolutely, Sonal. Some amount of risk is always involved in the hybrid space. If we are talking about arbitrage, then there can be very short time periods where there aren't enough, lucrative opportunities available, and returns can be very meager and very, very rarely negative as well. But arbitrage is the safest within the hybrid space, so you can take it as a category which is going to give you single-digit returns with equity taxation. So it's a real good place to go in. The risk is limited there. Now, talking about the other categories, they all have some element of equity, and wherever equity is involved, and of course, because that is, you're taking direct equity exposure, because not all the equity exposure is hedged. So the unhedged equity exposure is going to add some amount of risk. So there is a sudden correction, or the market movement, suddenly turns. There is some event which is disruptive. Maybe the fund is also sitting on slightly higher equity allocation. There can be a steep fall there. So number one, investors need to remember that risk cannot be totally eliminated. There will always be risk, but the risk-adjusted returns are going to be good. So if you're investing, please have at least, minimum of 2 years, because that's when the lucrative taxation kicks in. So you start with the 2-year kind of a horizon in mind, going up to 5 years and beyond, depending on the objective. Secondly, Sonal, that the taxation within some of the categories of hybrid is slightly complex, in the sense that, let's say, one multi-asset fund may not be eligible for equity taxation even after 2 years, depending on the percentage of equity that's going to hold. It may be different for another multi-asset fund. So you have to be sure of which fund are you investing in. So within the same category as well, the holding period when equity taxation kicks in can be different, as well as in rare cases, debt taxation is also there. And of course, the debt taxation is there for the conservative hybrid category. So that needs to be checked. And thirdly, I think it's just that, investors cannot buy a multi-asset fund or a balanced advantage fund and think that, everything is going to be all right. They have to do their asset allocation at a personal level of their, when they're constructing the portfolio, and not leave everything to the scheme. So the scheme can give them a better risk-adjusted return overall over a time period. But they have to be sure of what they're investing into. Like Mr. Rao also initially mentioned, that you have to understand what you're investing into and then, invest. And I think that's the biggest risk of investing without understanding. So other than that, I think it's a great category and subcategories for investors to invest.
Yes, totally get that point. And it's understandable. Unless you understand a category, how can you just go ahead and invest as well, right? Mr. Rao, your take on the risk associated with different categories. Who do they cater to? Which risk profile, so to say? And are they a better bet than fixed deposits? Is it fair to compare the two, first of all?
It's not fair to directly compare the two, because fixed deposits obviously guarantee returns, and you get exit a little overnight or immediately if you have a bank account, etc. But today we have reached a peculiar situation where taxation is at marginal rate for almost every way of debt investment. And today, hybrids or equity-based investments and equity investments more than 65% today give you the benefits of 12.5% long-term tax beyond 2 years. Therefore, you can consider them as a proxy for a fixed deposit with a limited amount of risk in arbitrage, and more so in equity savings funds, because there the equity exposure may be 35%, the debt exposure may be AAA, and the rest would be hedged kind of products. So I would say that investors should distribute their investments, which is in fixed deposits, across partly in fixed deposits, partly in arbitrage where the short-term returns is what the goal is, and FD should be a little bit put into equity savings funds, where on the downside you get 1 or 2%, but on the upside you get 7-8% long-term over 5-year track records. So the FD equivalent to me is either arbitrage or equity savings. On the broader risk on the category, I agree with most things that were said by Tauleen. But I just am concerned that the markets today are at all-time highs across the world. So the risk is slightly higher. People should not be thinking that it will not impact. But as we saw that even at a 6% fall, hybrids give alphas on the fall. So I'm not so worried about the risk. It's just that the time frame of investing should be minimum 2 to 3 years, because that is the time frame where risk gets evened out.
We get that point. So makes sense, not entirely fair to compare the two returns or the two categories as well. But Prableen, before we wrap on the show, if you can quickly tell us some of the recommendations for the viewers in the hybrid category that they can look at and analyze before they invest.
Absolutely. Sonal comes with the disclaimer that they must do their due diligence. Some of the funds which I like are the SBI Balanced Advantage, Parag Parikh Dynamic Asset Allocation. It's a newer fund, but I think it's a very credible fund house. They've managed their conservative hybrid fund very nicely, but that now comes under debt taxation. So dynamic asset allocation can definitely be looked, because it qualifies for equity beyond 2 years, 12%, 12.5%. Then within the equity savings, I would say Edelweiss is a good fund to look at. It can contain the downside well. ICICI multi-asset, and I would say arbitrage, any of the credible bigger fund houses, SBI, Tata, ICICI, Kotak. I think arbitrage is you don't really have to bother much. Any of the good fund houses, credible fund houses, you can go with.
Okay, all right. Take that point, Mr. Rao, Prableen. Such a pleasure speaking to the two of you and to get your insights on a topic which is very interesting and topical as well right now. So thank you so much for joining us today.
Thank you very much.
Thank you so much.
Okay, all right. With that, we'll take your leave on this edition of MF Corner, but you stay tuned for Closing Bell to take you through the last hour of trade.